NVIDIA delivered another blockbuster quarter, beating expectations across revenue, margins, and forward guidance yesterday. Yet the market reaction was dull. NVIDIA shares rose in the after-hours trading, but gains remain limited on the index level as investors around the world remain cautious, focusing on broader concerns about technology leverage, AI disruption risks, and stretched valuations across US technology stocks. In short, NVIDIA continues to execute flawlessly, but even spectacular results from the market's AI bellwether are no longer enough on their own to reignite global risk appetite. So welcome to Swissquote's Daily Market Talk. It's Thursday, February 26th. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
No surprise, NVIDIA announced another spectacular set of results when it reported its fourth quarter earnings yesterday after the US closing bell. The company made $68.1 billion in revenue, 73% higher compared to the same time last year, and 90% of that revenue came from its data center division. The net income almost doubled, and the gross margin improved to 75%. All these numbers were significantly better than expected by analysts. And to answer the questions and worries regarding the risk that Google's TPUs, for example, designed for AI inference, are way more energy efficient and cheaper than NVIDIA's chip would steal business from NVIDIA moving forward, well, the company's CEO Jensen Huang said that his company is the king of inference today, and that the Blackwell and the next generation Vera Rubin platform will extend that leadership further. And that, this is important, the adoption of agentic AI is skyrocketing. And although his words sound too good to be true, he's got the merit to have delivered grandly on his promises over the past 3 years. So with all that greatness coming, NVIDIA projected that its first quarter revenue will be around $78 billion, as far about $73 billion penciled in by equity analysts. In summary, NVIDIA's results were great, the forecast was great, the guidance was great, what is coming is great, and beneath the surface, the gap between revenue and cash generated closed significantly as well. So NVIDIA rose 3% in the after hours trading following strong results and will be challenging the $200 and plus offers today at the open. But that's not a huge reaction, is it? And if that reaction sounds a little meager to you compared to the strength of the results, well, it's because important headaches remain still. One, the Coastal Journal, which is now famous, having pointed last quarter at the significant gap between NVIDIA's revenue and cash levels, comparing the company's accounting practices to Enron's, hit again after the earnings yesterday, pointing this time that 36% of NVIDIA's revenue now comes from only two big clients. And two, well, these clients that are not explicitly disclosed are most probably those who are adding leverage to their balance sheet to make these purchases happen. And that's something that investors are being explicitly unhappy about since a few months now. So the fact that NVIDIA announced another crazy quarter doesn't necessarily reverse appetite as predicted across global financial markets. SoftBank in Japan rebounds almost 4% this morning on the back of strong results, but Nasdaq futures are pointing lower at the time I'm talking here, trailing also behind their major US and European peers. So the conclusion is NVIDIA could eventually keep its own head above the water on strong results and forecasts, but could no longer improve the global appetite for more risk alone. Voila. In other earnings, Salesforce, which was also closely watched due to SaaS apocalyptic environment, reported earnings yesterday and slipped 4.5% in the after hours trading despite beating analyst expectations on both revenue and EPS. Allows investors here focus on Salesforce's fiscal 2027 guidance, which came in just below consensus and signaled only mid to single-digit revenue acceleration. Many traders interpreted this as a sign that near-term growth remains tepid amid concerns about slowing enterprise technology spending and AI competition. And I'm afraid the latter may not improve appetite in software stocks. But this could. Anthropic's Claude, that is originally responsible for the SaaS apocalypse of the past few weeks, has had bad news yesterday. They have been hacked and taken hold of sensitive Mexican government data. That's not excellent news for the company, and the letter will at least help throw a floor under the cybersecurity stocks that were also hit by the SaaS apocalypse over the past few days. So overall, I have been reading analysts around the world hitting back against the Citrinni's earlier report that AI will be destroying everything, jobs, company businesses, and economies. And many, including myself, criticized this report for being just too dramatic and way far from realistic. Some even called it science fiction, and I think they're right. What is less fiction, however, is the fact that the private credit default risks are rising due to this sell-off. UBS, for example, this week rose the private credit default risk from 13 to 15%, warning that if an aggressive AI disruption could lead to further stress among corporate borrowers, well, that would be a bigger problem for the financial markets. JP Morgan CEO Mr. Jamie Dimon also made parallels with the subprime crisis. All this to say that the AI fears may be overdone on business and realistic level, but the way the financial markets react to the news could pose serious problems to the financial assets altogether, and that's never a good sign, really. Now, zooming out, the S&P 500 is set for a softer open this morning despite gains in Asian technology indices, and the waning US technology appetite means that the beneficiary of the rotation trade should be doing the heavy lifting to keep the S&P 500 in the positive territory, aiming for fresh record highs. And the rotation trade is given a new acronym these days, HALO, heavy assets, low obsolescence, suggesting that companies and sectors with large physical assets should eventually amass capital flows as they aren't easily disrupted by rapid technological change, unlike many high-growth software and AI names. The idea is that investors are rotating capital away from expensive AI and growth technology stocks and into businesses with tangible infrastructure and long-lived assets. Think of energy, materials, industrial, shipping, and other real-world enterprises, for example. So the FTSE 100 index here in this very context is quite well positioned to champion the HALO inflows, to say the least, and the index rallies from record to record every other session these days, carried higher by its energy, and mining names are heavily weighting in this index. And interestingly, yesterday's inflows into the FTSE 100 index were strong enough to offset sterling strength. And that's also a sign that inflows into the FTSE 100 companies is very much strong at the moment. Elsewhere in the FX, the US dollar remains under a decent selling pressure against most majors. The euro dollar, for example, extends gains above its 50-day moving average, a set of softer than expected inflation figures from the euro area yesterday backed the idea that the European Central Bank could eventually give support to the European economies in case of renewed external stress and need. And yes, I'm looking at you, tariff uncertainty. While the dollar-yen retraced yesterday's advance, but the Japanese yen bears still remain in charge of the market quite strongly indeed, on government's clear preference today for a softer Bank of Japan policy than aggressive normalization. And that's quite negative for the Japanese yen and is not good news for Japanese yen bulls, even though Mr. Ueda is in favor of careful normalization still. In the metal space, gold consolidates gains near the $5,200 mark this morning as US crude is marginally lower, with tactical bulls, however, waiting in ambush. If tensions between the US and Iran rise, and they could, we could see the $68 per barrel offers cleared easily for a rapid advance toward the $70 per barrel level. But if tensions ease, I would expect a decline below the 200-day moving average quite quickly, and that level is now standing near the $62.85 per barrel level right now. Overall, in the absence of major economic data and events, today should be about digesting NVIDIA results and software talk to understand what's next? Are the latest market risks, especially regarding technology, waning? Are investors getting ready to jump back in? Or has the pullback in technology been too soft to make the valuations look interesting for dip buyers? I would bet for the latter and think that the trading will probably remain cautious in the coming days before dust clearly settles. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.